And so you're going to be selling at 1124. When you get in at 1124, again, we put a little line right here. 1124, approximately where you're in. Now you have another set of targets that you can put in. You're going to put in the first target. Your first profit objective is going to be at 1104. Probably going to get you out on the same day if it slides down that far. Then you have the next target at 1084. Again, trying to line up this where we might have to go here or here. I'm not quite sure. I can't really read on here, but in other words, when you get that opportunity to cash out, it's not, nobody can go broke taking a profit, they say, and I know you're supposed to let trends run and let the profits run, but in the current market conditions, those are the types of things that you have to kind of think your way through and what you can take. So my preference would be, if I see these kind of situations, I'd take a little bit of profit if I can off the table before it disappears. So after the market comes on down, you're going to be in a situation, you're riding the market short. You still have that one contract left of the three. You have a predicted high right here where the market is starting to turn back around. As you note on the bottom with the differences, those lines are starting to turn up. You have the Neuro Index is at 1. All those indicators are corroborating each other, suggesting that this is more of a stronger market, a market that's tending to go higher. So you're going to, on this particular date right here, you have this predicted high, and you're going to try to place a stop somewhere at $10 above that. The predicted high was 1107, and so your out point is going to be something around 1107. Somewhere around 1117, somewhere around that. That would get you out of this other trade. Now, the next thing you might want to do is you might want to jump right back in because, the gold bugs and so forth are talking about the market going higher. So you have a situation here where you may want to ride an uptrend. The market starts to turn here. You have a predicted high here of 1107. I misspoke on the previous one. The amount really that where you got out was at 1099. So this one here is where you had the predicted high at 1107, and so that means that you are going to be a buyer at 1117 in here. Again, as I said, sometimes things work, sometimes they don't. In this particular case, it didn't work so good, so you'd want to keep your stop somewhere around the point of entry where you got in, and in case that market turns around, again, depends on how much risk you can tolerate, but you want to keep your risk small, make the loss small. In this case, you would have probably gotten stopped out if you are using 10 points as your criteria with a $500 loss. But that's not too bad considering that the previous two trades that we talked about, the two series of 3 contract trades, would have returned something like 15,000. Now we have a situation where the market again starts to turn back down. You have the predicted low here at 1105. That means you're going to put your stop in here to sell 1095. You're going to set your targets up, and hopefully, you're looking for them to get hit. You have 1075. You have it get hit here, so you have one contract where you have the money in the bank in your pocket. Then the second one is at 1055. And that happens the next day, so you have a couple of contracts where you've made some money. Again, this is 2,000 for the first one, 4,000 for the second one, and then you still have that third contract to play with if it would go on further. In some cases, obviously, the market's going to turn before you get there, and so you're going to have to get out, more quickly than market does start to turn around, you'll be out. The predicted high there was at 1069, so you would be out at 1079. Whether that would get you out of the market, it would get you out of the market, but whether that's as much profit as you want, up to you, but that's a nice profit on this third contract of $1,600. So again, you have another series of trades that you have made that have turned out to be highly profitable. Well, now we get to the current time. As I said, we are out of the market. We found a particular trade there. Now we have a situation where the predicted high because we have some indications here that the trend is kind of tilting to the upside. We have the differences moving up a little bit. We have the neural index at 1, and so you have a predicted high at 1082. That means you are going to put your stop to get into this market long at 1092. So when you get in at 1092, you start setting up your targets. The first one at 1112, somewhere right in there. And then you have your other targets, 1132, so forth, all the way up. You can line them up if you wish. And if you are following the market at all today, you know that when the market broke out of the holiday period, came back from the holiday very strong, and did shoot up through those particular target, that first target anyway. So you have, in this case, your current status is one contract you have gotten the profits on of $2,000. You have a second contract that so far is surplus, not stopped out yet, and a third contract that you can use then to let the market ride higher if it wants to ride higher. So you're kind of following the trend. At the same time, you're taking some profits along the way because you don't know for sure, if this trend is going to materialize, and you don't want to lose out on it if it's a situation where that market does start to turn around and take away some of that money that you worked so hard to get. Now we're going to go back to some of the some other markets and look at some other charts back at the gold market here, but we're going to look at a couple of others. Now I can't look at all the various markets, but I'm going to look at a couple of the popular ones. The first one I'm going to look at is the E-mini. As you know, the E-mini is probably the most popular contract for traders. It's a very active contract, very liquid contract, so a lot of people look at it every day as a gauge of what is going on in the stock market. Again, we aren't going to be able to look at every single item here, but we'll look at a couple of things that potentially would be indications of where to trade. First of all, in the market, let's cut back over here. Let's take a picture of this and make a few comments about that as to where we would get in, where we would get out, and how we would trade the breakouts of the trend. When we look at the markets here, we are also looking at the possibility of getting caught. So again, we are always looking at the possibility of the risk factor. Always keep that in mind. In this case right here, on this particular situation right here, we would be out of that previous trade where we rode the trade up and it would have come out there. So we would be kind of sitting here sideways until we come to a point in time on, I think it was January 21st, where this breakout started